financialisation is about visible results. It's about kind of shareholder value at the corporate level. So that's kind of one aspect of it. It's what you can see, what you can immediately measure. It's about kind of the capital market demanding more. If you did kind of a Lexis search on the term shareholder value, you will find in the 90s the bar chart of, in terms of annually, mentions of shareholder value will go up exponentially. And that kind of reflects management talking about shareholder value, about institutions talking about shareholder value, and also management trying to deliver increased returns. Not only increased returns, but the share price. Remember, all these kind of groups that I'm now talking about are second-hand dealers in second-hand shares. Hardly any of them put the original money into the company. They're buying second-hand shares in the secondary market and then demanding, without actually putting any capital into the company, but just taking ownership of that share, then demanding from the company increased returns. Another kind of feature has been value investment. Some companies, such as kind of the most tragic example I could give you is probably the British company, General Electric Company, GEC. For nearly 40 years, it was Britain's largest manufacturing company, run by Arnie Weinstock, a tight git who had never invested much, but generated returns, had a huge cash pile, but would only invest if the returns were high enough. But from a manufacturing perspective, he pulled out of consumer electronics, got involved in defence, rail, anything the government was involved in, and built up a cash pile. New management comes in and decides that we need to become a fast-growing company. So they sell off all the other bits and invest in telecom, mobile telephone infrastructure. At the same time, when the market turns down, GEC went bust, I think 6 years ago. Britain's largest manufacturing company. Shareholder value has dramatic results as well. In terms of financial results, the key measure of corporate performance is either the metrics such as EVA or the return on capital employed, ROCE as it's kind of popularly called. Could be before tax or after tax, but it's a return on the capital that the company has employed. The capital that's employed is counted as shareholder equity plus long-term debt. This is kind of coupled with increased competition. At the same time, increased returns are required. At the same time, what we're getting is mature product markets and demand very difficult to kind of capture. In terms of kind of governance, it licenses the privilege of just one group, shareholders. As you probably would have spotted all this debate about what are management paid for, it's also licensed management to actually up their own salaries. So in terms of governance, you're now privileging shareholder value. In terms of macro conditions, this is where it gets pretty interesting and also starts to demonstrate while the pursuit of shareholder value is, in my belief, appropriate, it's actually an unrealisable project for the whole economy. Because the macro conditions are about households and firms. The ultimate owner, the ultimate beneficiary of any shareholding must inevitably be the household, even though the shares may be held by different institutions. Demand, ultimately, isn't to satisfy household demand, even if it is a B2B transaction. Ultimately, you recover your costs by selling to the household. What we have here currently is an ageing population that is saving for its long-term welfare provision. So there is an increased flow of long-term savings. But those savings are not going to build social housing or other infrastructure projects. They were, to a great extent, being filtered onto the stock market. Because historically, the stock market returns were higher than any other investment. And that was coupled with an increased competition between fund managers about who could generate the returns and from where. All this kind of pressure builds up, and it's translated into the companies that have to generate the returns. I don't know if you noticed in the last boom, but companies were making people redundant when the economy was booming. I had never seen that before to that extent. You're closing subsidiaries, selling subsidiaries, restructuring when the returns are actually quite acceptable from a previous period. I mean, in terms of kind of savings, translating savings into issued shares creates a bubble. A bubble. A bubble in bank share prices, a bubble in the stock market, a bubble that will burst, and did burst. Because that bubble demands returns. We've been here before. I can connect the dot-com companies, the banking crisis, and also the next crisis, which will be about long-term savings. Can be all connected back to financialisation. In terms of kind of ownership of companies, I've stressed this point earlier, it is households own firms. The ultimate owners of all shares must be households, even though they may be held by companies. In terms of kind of other economies, Britain is unusual in terms of having this kind of relationship where the separation of ownership and control, to the extent where the shareholder is then independent and not involved in the company in any way. But there are other ways to organise. I mean, in other countries, you have kind of sometimes banks owning the shares of companies. Sometimes you have suppliers owning shares in the major company, or vice versa. There is kind of another way to organise. But the way the British and Americans seem to be organised seems to license this. And in terms of kind of household wealth, it may look like the banking crisis is victimless, other than the taxpayer has been put in the frame. Let me turn this back to you, and in a very interesting and relevant way. You're going to be in charge of your own pension fund. The days of kind of collectivised pension funds are over. If you were going to retire in 2008, when the value of the stock market fell, that would have had real wealth effects for you. It would have wiped out 40% of your savings for long-term savings provision to pay for your pension. In a pension, you don't take the money out, you buy an annuity. With the interest rates pushed so low, an annuity is where you hand over the money, and for a guaranteed period, you get a guaranteed return on that as long as you live, or as long as the contract lasts. So you're guaranteed you know what your pension will be for the next few years. Annuities, the returns that you get are high when the interest rates are high. The annuity falls when the interest rates are low. What has Britain been doing, and America been doing, and Japan has been doing for the last 5-7 years? Interest rates at below 1%. So if you took your pot out in 2008, then bought an annuity, right, you're going to be working for the rest of your life. These have real effects, but it connects back to the company. There is real effect back to the company. So there is real consequences. And in terms of financialisation, there's kind of a broad sense here that it's about corporate results. It's also about macro conditions. I've just given you one example of a macro condition. Because pensioners don't get up and put windows through, right, nobody tends to notice. But if it was, for example, the university pension scheme that was affected, the balance between the deficit that you have in what you were promised as a pension, that's a collectivised, not an individualised. You lot are all going to have individualised pension schemes. I'm in a socialised scheme. The socialised scheme is that if there is a deficit in the fund, it's made up equally between the firm, the state, and the individual. Financialisation has a real effect. What it has meant is risk is put on to you, and you can't see it. It matters. It matters at a micro level, it matters at a sectoral level, because it is what management must do. Management has to generate the returns. You're not going to put down the decline in the return in your long-term savings down to experience. You will want returns. In terms of the macro prosperity, I think the crisis that we now talk about as being kind of temporary, the next phase is about to arrive. That is, the baby boomers, people like myself, I was at the fag end of the baby boomers, will retire.